Okay, let's go through this fixed asset sale. We've got Swan Company, and they sold the delivery truck on April 1st, 2016. Now, they acquired the truck on January 1st, 2012 for $40,500. I'm simply reading the information you have here. Okay? So at the acquisition time, Swan had estimated that the truck would have an estimated life of 5 years and a residual value of $3,000. Now, at December 31st, the truck had a book value, this is December 31st, 2015, of $10,500. So what I'm going to do is illustrate requirement 1A. We're going to prepare the necessary journal entries to record the sale of the truck, assuming it sold for $9,875. Okay. Now what I've done is shrunk the question so that we could look at part of the solution. So the first thing we have to do is record the partial year depreciation. So we're going to debit depreciation expense, which increases depreciation expense, for $1,875 and credit accumulated depreciation for that same amount. Now, how do we come up with that? Well, yearly depreciation is the $40,500 cost less the $3,000 estimated residual value, and we divide that by 5 using the straight line method. So annual depreciation is $7,500. Since 3 months of the year are done, we can take 3/12 of that to come up with $1,875. Okay, this records partial year depreciation. Okay. Now I've repositioned some items on the screen now so you can see the problem and the solution, as well as an explanation for how we take care of the remaining entry, which is now to take the asset off the books. So if we were using an account called trucks to record the cost of the asset, the long-lived asset on our books, we're going to remove it at cost, and the cost was $40,500, so there's a credit to trucks. Now, they told us we received cash of $9,875, so we would increase cash with a debit, $9,875. So the other two entries we have to calculate is accumulated depreciation and the gain on disposal of property, plant, and equipment. Well, how did we come up with $31,875 of depreciation? Well, I believe they told us the book value at the time, and then we recorded some extra depreciation, right? So they told us there was $10,500 of book value. How did we come up with that? It was the $4,500 cost minus $30,000 of accumulated depreciation that must have been taken up to that point on the books, right? So if that was the case, we'd have $10,500 of book value. And we just recorded an extra $1,875 of accumulated depreciation. So take the $30,000 of accumulated depreciation that was already recorded, plus the $1,875, and we know that the accumulated depreciation up until at the time of the sale, right, would have been $31,875. So that's how we come up with that amount. Now, the difference between the book value at the time of the sale and the cash we received for it winds up as a gain on disposal of property, plant, and equipment. Now, another way of thinking about this is once you've recorded all of the entries correctly, meaning we've reduced the asset at its original cost, we've removed the accumulated depreciation at the value that exists at the time of sale, we record the cash, then the difference is forced, and if it winds up as a credit, it would be a gain. If it winds up as a debit, it would be a loss. So we've recorded, in this instance, a gain on the disposal of property, plant, and equipment. That's one way of thinking about it. The other way of thinking about it is what I said earlier, where you'd say, how much cash did we receive, or what was the value we received, and compare that to the book value at the time the value was received. Okay, if you receive more than the book value, you have a gain. If you receive less, you would have a loss. Okay, and that's just a quick walkthrough of how we would record depreciation expense, partial year at the time of a sale, and then record the actual sale or disposition of an asset, and show that and how the entries would be recorded to reflect that disposition or sale.